Hello traders, Bill Duryea here with Follow the Bots. Welcome to today's trade strategy review. We'll begin our discussion today with a brief context as to what has occurred in the market over the past 4 trading sessions. On Thursday last week, as the S&P was on its trajectory path up to retest a multi-year high at or near 1680. There was a minor pause or consolidation that found support at or near 1666. After auctioning up to 1680, the S&P pulled back late in the day to test support at 1666. In yesterday's market commentary, we noted that even though the market held support on the initial pullback, the price action indicated weakness into the close based on 2 factors. One was the time of day. The pullback happened late in the session. Secondly, the market failed to auction above the initiated selling point at or near 1674, 1673. 1673.74 was the high during Thursday's session. And while the cluster of trade that we're looking at is relatively small, the low 1666, the high 1680, nevertheless the midpoint, the median of the developing trading range, is located at or near 1673.74. The midpoint is the neutral price level. And so when the market pulls back to retest the low and only auctions up to the midpoint or the median, the reaction is only neutral. Therefore, we expected that the market would pull back and retest support. Indeed, it pulled back to retest support, but that occurred in the overnight session, limiting the opportunity for U.S. traders to participate in the pullback. Prior to the open, the market auctioned back to the midpoint and traded up to the high, pulled back again to the median point, retested the high and made a higher high, pulled back again to the midpoint and closed up off the low but failed to retest the high. This view of the developing trading range gives us the context wherein we can understand the trade opportunities that develop during today's session. Ideally, we would like to be there and participate in the trade opportunities. However, because the markets are 24 hours, often gray trades develop when we're unable to participate. Regardless if you are able to participate or not, it is important to keep track of the development for the sake of your analysis. Your inferences as to what might develop are separate from your ability to execute trades. Being able to draw the correct inference is the precursor to developing the appropriate trading strategy. Developing the appropriate trading strategy and understanding trade management is the precursor to being able to execute good trades. Therefore, in keeping with our inference as to what is most likely and or least likely to develop, we note the market development that occurred. Our inference that there was selling pressure at or near 1673.74 as the market broke down from the prior day's high was correct. The market did not auction above it and pulled back to test the low prior to making a higher high. Support, as we deemed it to be at or near 1666, was confirmed overnight. When the market auctioned back to the high again, you can see once more there was a minor pause as price traded back to 1673. However, on the minor downtick, there was initiated buying. High-frequency buy surges occurred. Therefore, if you thought to sell the overnight high, as opposed to looking at it as your profit target objective, the order flow monitor alerted you not to defend the high, and indeed to expect that the price trajectory would transit above the median point and auction back up and retest the high at or near 1679. Hence, there was a buy opportunity, a buy the breakout, and or buy the pullback opportunity, indicated here in number 3. The initial retest of the high, according to our Gaussian model, is an initial short opportunity after the market auctions up the first time from support. Ideally, we would like the distance between support and the high to equal an average daily range, 17 to 23 points. As you begin to think through the Gaussian mixture model, the quant version of market profile, you'll better understand that a rally of 17 to 23 points, a gain of approximately 1.5% in the S&P, is substantive enough to elicit a sell response on the initial retest of prior resistance. And indeed, that's what occurred when the market traded to the high prior to the open. The pullback again to the minor support level was the opportunity to go long. Ideally, on the pullback, we would have liked to have seen sell programs waning, as occurred here late in the day. However, there were no sell programs waning, but on the uptick, when the digital filters turned up, when the curve in the digital filters turned up, there was initiated buying, indicating that the market would likely retest the high. Notice the location of the stopping point in conjunction with the prior inflection point when the market transitioned into the upper quarter of the narrow trading range. When the S&P retested the high, we discussed in our live broadcast that there were 3 potential developments. Please make note of these potential developments and think them out for yourself. First, the market could encounter resistance at the prior high, as it had before, and pull back. Second, stops are likely to be located above the prior high, approximately 2 points. Often, the market will auction to the high and probe for stops. That will be the intention of the minor uptick above the previous high. That's a very common occurrence. Third, the market could break out and resume the trend. When buy programs waning occur at the high, and you see orders replenished, and there is no additional buy surge, and there is no additional high frequency or initiated buying, the probability favors the motivation for trading up 2 points above the prior high was to take out the stops that were resting there. This was another trade opportunity. This pullback here did not quite retest the low, and the market went modestly up. There was an opportunity there, but not as clear. However, at number 7, there was a retest of the low. Once again, there was no sell programs waning. However, the digital filters turned up, and notice again, when they turned up, you had initiated buying or high frequency buy surge, just as you did here. I'm going to ask my colleague Carl Weiss to comment on this, because apart from the order flow events that I have trained my eye to focus on, Carl is very adept at looking at the MACD indicator, and that assists him in inferring the likelihood that the market will rally up off of a low and or sell off from a high. The midday trade up to the high, number 8, had buy programs waning. However, the market languished here. This went on for several hours. No price change. Very low rate of trade. However, when this initiated selling occurred and the slope of the averages turned down, even though it wasn't at the high, this proved to be a good place to go short. The market auctioned back down and retested support at the prior low. This pullback here to the prior low was 1, 2, 3, 4, 5 times down to the prior low. There was a high probability that the market had rejected the high and possibly would auction back down into the lower quadrant of the trading range. However, there was no initiated selling during the pullback, and sell programs waning was indicated by the order flow monitor. The subsequent initiated buying or high frequency buy surges resulted in the market auctioning up off the 74s again and trading back at or near 1677. Coming into tomorrow's session, I wanted to talk about the probability range as it relates to the developments at the current high. In the event that the S&P auctions up to the prior high during the overnight session, and during the open of the Asian markets and the European markets, a positive sentiment develops, and the S&P were to break out above the prior high, relative to today's close, the range extension targets, what we refer to as the maximum likelihood expectation, following a breakout above the high, is up at 1692. The extreme price excursion level is located at 1700. Currently, the minor support level is down here at 1666, with the midpoint of the trading range at 1673. A break down below the minor support level under normal selling pressure could result in the S&P pulling back and retesting the prior high at 1650. This probability range is developed by looking back at market development in the S&P for 200 days. That concludes our trade strategy review for July 17th, 2013. Thank you very much for joining us.
Follow the Bots offers a completely new approach for traders. Follow the Bots provides you with tools that will allow you to trade with the bots and not against them. To learn more, take a tour of www.followthebots.com.